Let us look at the pro forma for an indirect method of presenting operating cash flow. On the previous slide, we agreed that when using indirect method, we would start with net income. Then you add non-cash charges. Why do we have to add non-cash charges? Before moving on, examples of non-cash charges include depreciation. We depreciate tangible assets. Amortization. We amortize intangible assets. And depletions applies to natural resources. So back to my question, why do we add non-cash charges? Recall that as far as income statement is concerned, the top line is revenue, then the bottom line is net profit. Depreciation, amortization, depletions will have been deducted to arrive at the net profit. But if you recall from the previous slide, we agreed that this indirect method starts with net profits. So several adjustments will be made to move back to revenue. Since depreciation was deducted to arrive at net profit, to move back to cash revenue, then we have to add it. And that's why this is being added. Loss from sale of a non-current asset. The loss will have been deducted to arrive at the net profit. So to move back to cash revenue, what do? We will add it. If we have gained from sale of a non-current asset, it will have been added. So to move back to cash revenue, what do? We will deduct it. And that's why this is being deducted. So loss from retirement of a debt, since it's a loss, it will have been deducted to move back to cash revenue. That's this here. What do? You will add it. So for gains from retirement of a debt, you will deduct it on the cash flow statement. Loss on investment accounted for under the equity method. It's a loss. Since it's a loss, we will have to add it. We will discuss the adjustment for working capital on the next slide. So if you add all of these together, then you will have operating cash flow. One more thing to note, as far as this slide is concerned, it is worth noting that taxes paid and interest expenses will have been deducted to get your net income. Recall that from our income statement, if you have EBIT, the interest will be deducted and the taxes will also be deducted to arrive at your net income or net profit. So if that is the case, once you are given net profit on the exam day, start with net profit and look away from any distractions coming from taxes paid and interest expenses. But if you are given EBIT on the exam day, you need to adjust back to net profit. So to adjust back to net profit, the interest will be deducted and taxes will be deducted. So the bottom line here is that if you are given EBIT, then interest expenses and tax paid will have to be deducted so that you get your net income. But if you are fortunate enough to be given net income, then look away from these two items. Still on indirect cash flow statement, before diving deeper into the working capital adjustment, it is important to understand their principles. So let's look at their principles. Working capital adjustments include all assets with useful life less than or equal to 1 year, or all liabilities that are expected to be settled within 1 year. It is worth noting that working capital adjustment does not include cash, and the major reason why it doesn't include cash is because the whole essence of our cash flow statement is to adjust for the changes in cash. So if you add this plus this plus this together, you will eventually end up getting the changes in cash from last year to this year. Moving on, let us look at the rule that would guide us in making the working capital adjustment. If current assets such as inventory, account receivable, prepaid expenses, deferred tax assets, if these current assets increase, then we expect cash to decrease on the cash flow statement, and vice versa. So let's get started with this first example. Let's imagine we are dealing with inventory. In 20x1, let's imagine we have inventory of 40. Then in 20x2, the inventory has increased to 70. The increase, the change is 30. So this change will be deducted on the cash flow statement. So this change of 30 will be recognized under the cash flow from operations, and it will be recognized as minus 30. If we have something of this nature, let's say in 20x1, account receivable, which is also a current asset, is 70. Then in 20x2, it has reduced to 50. Here, we are dealing with a decrease, and the decrease is 20. The decrease would be added, that's the decrease of 20 will be added on the cash flow from operations. Now moving on to current liabilities. If current liabilities such as account payable, deferred tax liabilities, wages payable, salaries payable, accrued liabilities, if they increase, then we expect cash to increase, and vice versa. That means if current liabilities decrease, then we expect cash to also decrease. So let us look at just one example. Imagine in 20x1, we have account payable of 50, but by 20x2, the account payable has increased to 60. What will happen on our cash flow statement? This change of 10 plus 10 will be recognized under cash flow from operations as a cash increase. That is, we will recognize plus 10. Please be reminded that no cramming is allowed, so we will discuss the logic behind what I have here on the next slide. Increase in current assets will be deducted. To make sense out of this, let us look at this example. Imagine we have inventory. Recall that inventory is a current asset. We have, let's say, inventory of $40 in 20x1 and inventory of $70 in 20x2. Let us also imagine that cash at the beginning of each year is $100, and this cash is available to purchase any current asset. In 20x1, you decided to purchase $40 worth of inventory. How much cash will be left? The cash that will be left will be $60. In 20x2, recall that we agreed that we are keeping cash constant on a yearly basis. If you purchase inventory worth $70, how much cash will be left? The cash that will be left will be $30. What does this mean? This implies that your cash has decreased by $30. And that's the major reason why we subtract increase in current assets. Let us look at another example. Let's imagine we have account receivable in 20x1 to be 30, then in 20x2 to be 70. Let us keep sales constant. Recall that sales could be cash sales or credit sales. So let's keep sales constant at $100 per year. If you sell $100 worth of goods in 20x1, but 30 out of these $100 were sold on credit, how much cash will you have? You will have $70 worth of goods in cash. But in 20x2, you sold $70 worth of goods on credit. That means the cash you will have, still keeping these constants per year, the cash you would have would be $30. What has happened to your cash? Your cash has decreased by $40. So that implies that whichever current asset you are dealing with, whether it is inventory, account receivable, and so on and so forth, obviously except cash, once current assets increase, then you need to deduct it. Decrease in current assets would be added. Let us move on to another example. Increase in current liabilities. What should happen? To better understand what is going on, let us give a very good example. Imagine we are dealing with a short-term loan. If in 20x1 you decided to go to a bank to get a 3-month loan worth $40. But in 20x2, the 3-month loan, the 3-month, that is a short-term 3-month loan, let's say it is $70. Here in 20x1, if you get a loan of $40, what will happen to your cash? The bank would give you cash worth $40. But in 20x2, if you get a loan worth $70, then you will have more cash in 20x2 compared to 20x1. And what that implies is that the change will be added. That's the change of $30. You can easily deduce that decrease in current liabilities would obviously be deducted. Let us get started with the direct method of preparing the cash flow statement. Using the direct method, the cash flow from operations can be computed as follows. So we have the pro forma here. Cash collected from customers is an inflow. That will be positive. Cash paid to suppliers, that will be negative. Cash paid for operating expenses, that is negative. Cash paid for taxes, that is negative. Then cash paid for interest expenses will also be negative. All of these are all outflows, and they would be a negative figure if you are computing operating cash flow. Upon adding all of this together, then you will have the operating cash flow using the direct method. How do I remember? The way I remember is this: C shorty, cash collected from customers, that's C, then minus all of this, cash paid to suppliers, cash paid for operating expenses, cash paid for taxes, then cash paid for interest expenses.